Traditional finance now faces a serious challenger. Imagine a financial system without big banks. Picture direct peer-to-peer transactions for everyone. DeFi aims to make this vision a reality. Blockchain technology is at its very heart. It allows for secure, transparent record-keeping. This shift challenges established financial norms. The potential impact of DeFi is enormous. It could make financial services more inclusive. DeFi aims to reach people without bank accounts. It also promises users more control over their assets. Developers are constantly building new DeFi applications. The goal is a more equitable financial future. Finally, we will look towards DeFi's future path. So, what exactly is decentralized finance? DeFi is a term you hear often now. It represents an alternative financial system. This system is built using blockchain technology. Blockchain is a distributed, immutable ledger. It records transactions securely and transparently. Smart contracts are absolutely crucial in DeFi. These are computer programs stored on a blockchain. They automatically execute when certain conditions are met. There is no need for human intermediaries. This automation is a core innovation of DeFi. It makes processes more efficient and reliable. DeFi aims to create a truly open financial system. This decentralized system operates on a global scale. DeFi services are available 24 hours a day. This transparency is a hallmark of DeFi. DeFi is composed of several key building blocks. Decentralized exchanges are a prominent example. These platforms are commonly known as DEX. They allow users to trade cryptocurrencies. Users can do this directly with one another. This is called peer-to-peer trading. No central company or intermediary controls the trades. On a DEX, users typically retain custody of their crypto. This can reduce certain types of risks. DEX use smart contracts to facilitate trades. The entire trading process is automated by code. Lending and borrowing platforms are also vital in DeFi. These platforms connect lenders directly with borrowers. Smart contracts manage the entire loan process. This efficiency benefits both lenders and borrowers. Stablecoins play a very important role in DeFi. Their value is often pegged to an external asset. This stability makes them useful in DeFi. It makes DeFi applications more user-friendly. People can transact without fearing large price swings. Yield farming is another popular activity in DeFi. Users provide their assets as liquidity to DeFi protocols. In return for this service, they earn rewards. These rewards are often paid in more cryptocurrency. Liquidity pools are fundamental to yield farming. Users deposit pairs of crypto assets into a pool. These pools create the liquidity needed for trades. Providers of liquidity earn fees from transactions, or they earn interest from lending activities. However, providing liquidity also involves specific risks. Section 5. A new financial paradigm. DeFi versus traditional systems. DeFi presents a stark contrast to traditional finance. The traditional financial system has many gatekeepers. Banks and established institutions control access. This often involves lengthy approval processes. DeFi, on the other hand, champions open access. It aims to be permissionless for all users. Anyone with an internet connection can typically join. A crypto wallet is usually the only requirement. The traditional financial system can often be opaque. DeFi, in contrast, strives for radical transparency. All transactions are recorded publicly on the blockchain. This transparency is designed to build trust. The underlying smart contract code is often open source. It shifts power towards the individual user. Section 6. Open doors and fewer intermediaries. Key DeFi distinctions. Many DeFi applications operate without requiring KYC. Traditional banks are legally obligated to perform these checks. The absence of KYC in much of DeFi lowers entry barriers. It allows for a greater degree of user privacy. However, this aspect also attracts significant regulatory scrutiny. Governments and financial watchdogs are concerned. They worry about the potential for illicit financial activities. Traditional finance relies heavily on various intermediaries. Banks, brokers, and payment processors are common examples. These entities act as middlemen in financial transactions. DeFi aims to significantly reduce or remove these intermediaries. Smart contracts automate many of the necessary processes. This disintermediation can make finance more efficient. It has the potential to lower transaction costs. Section 7. Navigating the choppy waters. Risks inherent in DeFi. While DeFi is innovative, it is not without risks. Users must be aware of these potential dangers. Smart contract vulnerabilities are a major concern. Malicious hackers can exploit these weaknesses. Exploits can lead to the theft of user funds. The security of smart contracts is paramount. Smart contract audits can help identify some bugs. However, audits are not a perfect guarantee of safety. The technology itself is still relatively new and evolving. Scams are unfortunately prevalent in the DeFi space. Rug pulls are a common type of fraudulent activity. Phishing scams are also a significant threat. Price volatility is another key risk in DeFi. Most cryptocurrencies are known for their wild price swings. This volatility directly impacts DeFi investments. Section 8. The upside of decentralization, DeFi's tangible benefits. Despite the inherent risks, DeFi offers compelling benefits. The potential for high yields is a primary attraction. Users can often earn higher interest rates. This is especially true when compared to traditional savings accounts. These returns can sometimes be significantly greater. This is a major draw for investors. DeFi protocols generally have lower overhead costs. Smart contracts automate many operational tasks. Lenders and borrowers can connect more directly. This reduces the need for intermediaries taking a cut. DeFi can greatly improve financial access globally. Billions of people around the world are unbanked. DeFi typically only requires a smartphone and internet. Users in DeFi often retain more control over their funds. This level of self-sovereignty is powerful. Section 9. The road ahead. Future trends and DeFi's financial reshaping. The future of decentralized finance is evolving rapidly. We are witnessing growing institutional adoption. Large traditional financial firms are exploring DeFi. They are starting to invest in promising projects. Some are even building their own DeFi platforms. This trend brings more capital and legitimacy. Regulation is undoubtedly on the horizon for DeFi. Governments and regulatory bodies worldwide are watching closely. They are actively developing regulatory frameworks. Cross-chain DeFi is emerging as a key trend. Cross-chain solutions aim to build bridges. They allow assets and data to move between blockchains. Layer 2 scaling solutions are crucial for DeFi's future. They help improve transaction speed significantly. DeFi is truly revolutionizing finance.